If it's Friday, it's three buys and a bail, and we're going to trade some of the themes dominating the headlines this week. Today's weaker than expected jobs data, the second Fed pause in a row, solar stocks sinking on a big warning from Solar Edge, and weaker Chinese demand, pressuring results from companies ranging from Canada Goose to Apple. New Street Advisors Delano Sapporo has a trade on each. But before we get to his picks, let's take a look at the state of the consumer in China with CNBC's Eunice Yoon.
Kevin Lee's suit shop in Beijing's premier shopping district was relied on by financiers and real estate executives. But not this year, with business down 30%. The biggest reason people don't want to spend is the uncertainty about the future, he says. That's hitting brands such as Apple, Canada Goose, Estee Lauder, and Yum China's KFC.
So much is weighing on Chinese consumers' minds, like all the income lost during the pandemic lockdowns here.
Retail sales are up 5.5% through September, but that compares poorly to 8.2% for the same period in 2019, before the pandemic. Instead, household deposits in the first half were up 9.8%, the biggest increase in a decade. Families feel poorer because of the real estate slump. New home prices are down 0.3% in September, the steepest fall in almost a year. Unemployment is high, especially among young people, at 21.3% last recorded. Everyone feels unsafe, this doctor told us. She cut her clothing budget from $150 a month to zero. All my friends, no matter the industry, are worried, this interior designer says. Frankly, I don't see any hope. Taylor Lee says customers who do come to his shop are spending less. Before the pandemic, they would buy suits for $3,000. Now they choose $700 options. I doubt consumption comes back even next year, Lee says. Eunice Yoon, CNBC Business News, Beijing.
Delano, welcome. Before we get to your China pick, I'm going to tell you a quick story. Once when I was in Hong Kong, I went to a suit shop like Taylor Lee's there to have a suit made. It was a well-known one. And I walked in. It was Chinese New Year, and the traditional greeting in Cantonese is Kung Hee Fat Choi, which means I wish you good fortune. But the guy said it to me. He said, Kung Hee Fat Choi. And I thought he said, come here, fat boy. It was crazy. I mean, so anyhow, that was my welcome to the suit shop. Let's take your China pick. It is Qualcomm. Why?
Thank you for having me, Tyler. There's a few reasons why. You mentioned all the struggles that we're seeing for consumers, especially obviously in China. I think when you look at Qualcomm, they're doing things that obviously it's better for the company. If you look at they have new competitors emerging with Huawei starting back up, but they're still estimating that their 35% increase in sales to Chinese smartphone companies. Some of that softness we're seeing in the smartphone companies is starting to ease off a bit as there's fresh inventory. We know Apple's obviously had their new rollout, and they renewed their contract with Apple as well. So I think that broader move, and we move over into the holiday season, will ease a little bit of that softness for consumers, especially when we're thinking about electronics, which are sometimes a heavy, heavy gift, obviously around the holiday times.
Well, let's move on to our second category, which is what's going on in rates. This was our mystery chart, and your pick here is?
It's Charles Schwab. And I think for a couple of reasons. So the TD acquisition, they're finishing the integration, and recently they're about over another 1.3 trillion in assets. The big thing for all of March, when you think about the banks and the discount brokerage, they had a tough time. But I was looking at obviously their earnings, and one thing that stuck out to me was they're looking at the cash sorting, so the move from their interest-bearing accounts, their bank sweeps, to these higher yield, whether funds or different cash yield funds. They're seeing that slow down and ease off a bit. And then I looked at the valuation for Schwab. They're trading pretty favorably here. They're down closer to 15 times on their price to earnings. So with the rigorous expense control that they do, historically, I think it's a good move for investors to kind of look at Schwab, especially how it's been discounted since March.
All right. Solar has been in the news this week. How can I be a high roller in solar?
So I like FSLR here in a couple of reasons. When you think of the solar companies, this is one that's obviously a growth company, but it's relatively stable comparably when you look at the market caps of the other solar companies, and their growth expectations are still strong. So 2024, they're looking at earnings roughly going up 65%. And so if you look at their forward PE at 10 times, I think that's a potentially undervalued play for investors if they think that they can reach those expectations, that's trading at a favorable discount right now. So last quarter, compared to one of their biggest competitors, Enphase, their revenue expanded, their margins expanded on the opposite side for Enphase. So, also looking at their balance sheet, Tyler, I think solid balance sheet for a growth company with not a lot of debt and $1.3 billion in cash. I think that's actually a really, really strong play potentially for investors.
There are your three buys. Let's move on to the bail, and that comes out of sort of the labor market. It could come out of a lot of different sort of categories, consumer, retail, and so forth. The bail is Target.
Yeah, and this is what I've been holding. And so some of the positions I let go at gains, some at roughly break even, and some at losses. And I think, when you look at Target and all the discretionary names right now, some of them are having a lot of trouble. Target's looked at, they've mentioned obviously the high inflation the consumer's been hit with. They've also mentioned the student loan moratorium that's going away, and overall a weaker consumer. So, when you look at the jobs data, we moved to 3.9% now unemployment this morning. A lot of that less discretionary spending, I think that flows potentially from Target to more of those discount retailers like Walmart, which Walmart's been having a really, really strong year in comparison to Target so far year to date as far as the stock performance. So I think the competitor continues to gain here if a consumer even gets in a more tough position. I think, Target essentially sees more, it's not at the bottom yet, but I think that bottom will come, but just not yet.